The Federal Reserve has decided to hold interest rates steady for the second consecutive meeting. This decision underscores the Fed's cautious stance as it navigates a complex economic landscape marked by fluctuating variables. Currently, the federal funds rate remains in the target range of 4.25 to 4.50%. This steady approach comes in response to a stable labor market and manageable inflation metrics. Interestingly, the Fed's recent actions included a 25 basis point cut, yet officials seem reluctant to pursue further reductions in the near term. Today's decision is pivotal. The yield on the U.S. 10-year Treasury note jumped 6.1 basis points to 4.446%, hitting a 4-week high. This shift highlights the immediate market reactions to the Fed's policy choices. The Fed has also adjusted its core inflation projections and modified the dot plot, dampening expectations for future rate cuts. This cautious stance is largely driven by economic uncertainty, particularly in light of recent policy changes under the Trump administration, such as intermittent tariffs. The resilience of the economy allows the Fed to adopt a wait-and-see approach, carefully assessing the potential impacts on inflation and growth. Analysts predict this observational stance will continue, possibly leading to a gradual reduction in rates later this year. However, a significant downturn in the labor market could prompt a rate cut sooner. Notably, the Federal Reserve plays a crucial role in the global economy, though its operations often go unnoticed by the general public. Recent studies indicate three trends: an expanded Fed balance sheet, reduced insulation from political influences, and challenges in managing contemporary inflation. The Fed's primary objective with the federal funds rate is to regulate macroeconomic variables like inflation and unemployment. Over time, its policies have shifted in response to major events, from the Great Recession to the COVID-19 pandemic. Members of the Federal Open Market Committee vote to set appropriate interest rates, closely watched by market participants since short-term interest rates drive currency valuation. The Fed's monetary policy significantly influences long-term economic trajectories, suggesting investors adopt a strategic long-term approach. Reducing interest rates lowers borrowing costs, encouraging businesses to expand, hire more workers, and increase production. Conversely, raising rates can temper economic activity and prevent runaway inflation. Interest rate changes impact consumers' and businesses' ability to secure credit for important expenditures, affecting various sectors from mortgages to stock valuations. Central banks lower rates to stimulate growth during downturns and raise rates to control inflation during overheating periods. Despite uncertainties, officials expect another half percentage point rate cut by the end of 2025. This optimism lifted the Dow Jones Industrial Average by over 400 points following the announcement. However, Fed Chair Jerome Powell emphasized the bank's readiness to maintain high rates if necessary. The Federal Reserve's dual mandate is to sustain full employment and ensure price stability. Consumer spending has declined, and tariffs are expected to drive prices up. Core price indices are projected to rise at an annualized rate of 2.8%, up from previous estimates. In addition to its rate decision, the Fed is reducing its quantitative tightening program, allowing only $5 billion in maturing Treasury securities to roll off its balance sheet each month, down from $25 billion. However, the cap on mortgage-backed securities remains at $35 billion. Today's announcement reflects the Fed's cautious yet responsive approach to an evolving economic environment. Stay informed, and thank you for watching.